The regional banks have always been a source of competition for us, and they've been a very aggressive source of competition for us. And when those failures happened, throughout the regional banking industry, the spigots were shut off on commercial lending, and we immediately saw the benefit of that with inbound transaction flow for sponsors looking for financing.
I'm here today with Tom Lorenzini, President and CIO of Seven Hills Realty Trust. Seven Hills is focused on first mortgage loans secured by middle market and transitional CRE. Can you provide color on your investment strategy and the diversification of your portfolio?
So middle markets, that's, as you mentioned, that's our lending arena, and really we define the middle markets as asset values, the collateral values, whatever the type of real estate may be, between $25 and $100 million. So that generally is 80% of the universe of commercial real estate. So obviously one of the deepest markets out there, and one that we're very active in. So we're lending in the bandwidth between $15 and $75 million on those assets. Now those assets generally are your traditional multifamily assets, industrial assets. Historically, we've financed office assets, retail, things of that nature. Our lending profile, if you will, generally are cash flowing assets with some sort of value creation to them. So it might be a situation where we're financing an office building, multifamily asset. Maybe it's a multifamily where property's fully leased, however, it hasn't been rehabbed or updated in 10, 12 years. The buyer's coming in with fresh capital. They're going to contribute some equity to upgrade the units. They're going to push the rents to market. That's a good situation for us to lend into. Could be an industrial asset maybe that has a near-term role in a lease, and they're significantly below market, and our client is going to acquire that asset. They need some additional money to re-tenant that space when it rolls over, and that would be a good example of a transaction that we would chase. We find ourselves that we don't necessarily compete with the largest providers of capital in the space, because more often than not, they're starting kind of where we stop, at that $75 million mark. A lot of the larger mortgage REITs and debt funds and life insurance companies, et cetera, will start lending above $75 million, so we're not competing there. So we feel like from a competitive standpoint, we're well positioned within the middle markets.
Your first quarter earnings call, you highlighted that alternative lenders are positioned to benefit as a result of the recent disruption in the banking sector. Have you seen an increase in loans opportunities as lenders have moved to the sidelines?
Yeah, it was very quickly and rather dramatically, end of Q1, right, when we saw Silicon Valley Bank and then subsequently Signature Bank and some of the others run into trouble. The regional banks have always been a source of competition for us, and they've been a very aggressive source of competition for us. And when those failures happened, throughout the regional banking industry, the spigots were shut off on commercial lending, and we immediately saw the benefit of that with inbound transaction flow for sponsors looking for financing. So while in 22, as the Fed continued to raise interest rates, local and regional banks were very competitive. We saw our cost of capital rising dramatically. As a result, transactions were starting to slow down. The banking crisis, mini banking crisis happens, and all of a sudden it rebounds dramatically. So alternative lenders such as Seven Hills and some of our competitors are certainly in a good spot today to pick up market share, and we expect to do so quite a bit in the second half of 23.
And Seven Hills had 25 loans and $675 million of commitments at the end of the first quarter. What are your plans to continue a growth portfolio, and how do you expect it to evolve based on opportunities in your pipeline?
Yeah, I think again, we're active, and I think that you'll see our portfolio round out a little bit more with probably more multifamily loans today, probably additional industrial loans. We're currently working on hospitality loans, so that'll round out the portfolio a little bit more. We're less excited in today's environment about writing new office loans, so I expect as some of the existing office loans that we have in the portfolio will begin to roll off, you'll see that percentage decrease while the other asset classes kind of take their place, right, and increase those allocations. I think, as I mentioned before, I think the second half of '23 is going to be an active period for lending. I think the Fed has signaled that they're at the end or very near the end of the interest rate increasing cycle, which will help transaction flow pick up again as buyers and sellers can now understand the rules of the game, the cost of capital, and begin to have trades. And then we'll see more opportunities to lend our capital. So we expect to grow. Short answer is we expect to grow the loan book here in the back half of '23.